Hi, I'm Kenton, and this is Kenton Knows. In this video, I'm going to share some of the annoying real estate related misinformation that I hear much more often than I should, and I thought it would be a fun and informative video to do while hopefully preventing these incorrect ideas and statements from being perpetuated any further. As always, if you like this video, please hit the like button and consider subscribing to my channel. Let's start with my favorite or most annoying misunderstanding: cement versus concrete. Please stop saying cement when you are actually referring to concrete. Cement is essentially the glue that holds concrete together. I won't get into the complexity of how cement works, even though it is a really cool chemical process, which is why it is warm to the touch when curing. Yes, concrete cures. It does not dry as it gains strength. Although it normally achieves approximately 99% of its strength in 28 days, the chemical process actually continues to strengthen for many years. Concrete is essentially water, cement, and varying sized aggregate, usually from fine sand up to gravel. The various sized aggregate interlock and provide the compressive strength of concrete. Rebar or mesh is normally added to give a slab, wall, or column tensile and shear strength. Admixtures can be added to speed up or slow the curing time, add color, or affect the plasticity of wet concrete. Hopefully that wasn't too much concrete talk for you, but please stop saying you need a new cement driveway or your cement patio is cracked, because you really should be saying concrete. What about the due on sale clause? Every time I hear someone say, don't transfer your property to an LLC or the bank will call your loan based on the due on sale clause, I want to ask if they've ever asked for backup or tried to verify this advice, as they are clearly just reiterating what someone told them, and this just isn't a legitimate thing to worry about. First, I'll explain what it is. The due on sale clause is a clause that says the lender can call in full the loan balance if you do something that violates a covenant of the loan. Whoa, that sounds scary. But wait, like most contracts, when you violate something, you have a right to cure, meaning the lender notifies you that you did something and you can correct it or change it back. Here's the most common scenario. Fannie Mae and Freddie Mac require all residential conforming loans to be made only to real people, not companies, and if a mortgage company originates a loan that it wants to sell to Fannie or Freddie, then the loan must meet all of the Fannie or Freddie criteria. In the not too distant past, Fannie and Freddie had a due on sale clause which would be triggered by transferring the property to an LLC after the loan had closed. So this was a concern in the past. However, I have never heard of a bank actually notifying anyone of this, especially since we have been in a decreasing interest rate environment for quite some time. Theoretically, the only reason the bank would want to call the loan would be if your loan was at a very low rate, and by calling the loan, they would force you to refinance it at a higher rate. However, both Fannie and Freddie have changed their language to now allow the transfer without triggering the due on sale clause, so you no longer need to worry about it. I'll include a link to the exact section on both Fannie and Freddie's websites so you can actually see the backup and verify it yourself. I mean, after all, why should you trust me without the backup either? I also hear people complain that a company they are using for payments is asking for their tax ID or social security number so the company can report the payments to the IRS. Lately, I've seen posts by landlords complaining that their property management system, which automates rent collection for them, will be reporting the payments that they collect through their platform. How naive are you to complain about this? You are essentially saying that you are annoyed that a company which is providing you a service, which you obviously enjoy using, is following the law. You are saying that you do not want to report your actual earnings, so you are mad that this company is going to hold you accountable to do what you should already honestly be doing on your own. And then you actually post your disgust on a social platform which openly says to anyone reading between the lines, I want to misrepresent my income, and I'm really annoyed that this company is going to make that harder for me to do going forward. Really? I mean, the tax code is written incredibly favorably for real estate owners and investors, yet you are still getting mad at a company for doing the right thing because it makes it harder for you to lie to the IRS, and you're posting about it? I fully support using all the legal deductions and accounting options to reduce your taxes, but please do the right thing by reporting your income correctly, and more importantly, stop complaining and posting about it. I don't mean to joke about gas, but when someone says they smell gas, it's rarely the case. Natural gas, propane gas, carbon monoxide, and carbon dioxide gases are very dangerous gases which you may encounter in your home or investment property. What makes them especially dangerous is that they are completely colorless and odorless, meaning you cannot see or smell them. Since propane and natural gas can be supplied to our property intentionally, it has an additive which makes any leak smell like sulfur or rotten eggs. If you smell rotten eggs, then you are smelling propane or natural gas, and you should get out of your property and call the gas company immediately. If you smell something else, it is probably sewer gas, garbage, or something else entirely. Be sure you have a smoke and carbon monoxide alarm in your house to detect these dangerous gases, but just be aware you are not actually smelling propane gas, natural gas, carbon monoxide, or carbon dioxide because it is physically impossible to do so. It seems that new real estate investors think they need to create an LLC before starting to invest in real estate. I completely disagree with this belief. It's hard enough to learn how to find a property, finance it, renovate, lease, maintain, and manage it, but the LLC is not needed to do any of that. LLCs have absolutely zero effect on your taxes as it is a pass-through entity. For a liability, just be sure you have a landlord insurance policy and an umbrella policy when you close on your first property. If you decide to continue down the path of buying more properties, there may be some good reasons to create an LLC or a series LLC, which is what I use in Illinois. But you need to understand the reasons why you are creating the LLC. LLCs don't protect you from negligence, and insurance should cover any liability issues you'll encounter. But like anything else in life or business, don't just do it because you've heard other people are doing it. Actually try to learn and understand why, and if those reasons are relevant or important to you. There are actually some investors who strongly believe that LLCs are a waste of time and money, and they own a lot of properties without using LLCs at all. I don't have any statistics to back this next claim, but I do believe the majority of larger investors use LLCs. But again, please learn the reasons why before setting one up for yourself. Why do people speak about write-offs as if it's free money? Just write it off. When you write something off, what you are really saying is that you bought something for a legitimate business purpose, and the tax code allows you to write off or deduct a portion of that expense. It's not like you don't have to pay for it because you can write it off. If you buy an item for $100 and your tax bracket is 30%, then you will get to deduct $100 from your income, and you will pay taxes on your income less the $100 write-off, which is equivalent to saving $30 on your tax bill. So the write-off is generally worth your tax rate times the full value of the item you are writing off. Some items may have a higher or lower value deduction, depending on what the government deems to be important to incentivize businesses to spend more money on in a given year. But be sure you know what you are saying when you say to just write it off. While we are talking about taxes, I am amazed at how many people don't understand how the US tax code is progressive, meaning every person in the country pays the same tax rate on the first dollar they earn each year. And when you earn $1 over the current tax bracket, you only pay higher taxes on the money earned in the higher bracket. You do not pay more money on all the money earned in the lower tax brackets. So you shouldn't stop working to avoid going into the next tax bracket. It only affects the money earned over that threshold. I don't know why this is so confusing or why people just don't get it. If you don't understand what I'm saying, please look it up because it is really important to understand this. I also get annoyed with real estate agents who tell me they are selling a condo with a deeded parking space when they are not. My first question is, are you sure it is a deeded space? And what is the property index number or PIN? If a space is deeded, then it has its own legal description, PIN, and a separate tax bill. Many times, the space is simply a limited common element which is assigned to the particular unit. For most condo buyers or owners, the distinction isn't going to change anything. But as agents, I just think we should be clear in what we are buying or selling. While we are on the topic of shared spaces, let's talk about homeowner associations or HOAs. In my experience, homeowner associations can be a major pain. Here you have a bunch of homeowners who all seem to think they know what is best for the property, and they come from vastly different backgrounds, which means they have incredibly different values. So, one owner may want to have a huge reserve, while another may not want one at all. I don't mean to stereotype, but normally properties with older residents lean towards higher reserves, so they will rarely have any special assessments, as the residents may be on fixed incomes and can't absorb a large assessment. Personally, I'd want very low reserves and pay for the repairs as needed with a special assessment, as I don't want my money tied up with a condo board to use as they see fit, but I know that wouldn't be a popular idea with most condo boards. Some residents want the lobby and landscaping updated every few years, while other residents don't think those are important investments. As a resident, these squabbles are annoying, but if you're an investor, You won't want the residents doing any of these projects, as they won't translate into higher rents, but they will increase your assessments to do these pet projects, and those higher assessments will decrease your income. So, if you're an investor, I'd advise you to stay away from HOAs if you can. Homeowners don't have the same objectives as investors. What about home warranties? I personally think they're an incredible waste of money. It is, in my opinion, expensive insurance on your appliances, which have a ton of exclusions, and the company will send out a repair person to try and put a band-aid on it so it will last until the warranty expires. Do yourself a favor and put that same money into a high-yield online savings account and plan to either repair or replace your appliances as needed yourself. Don't bother with the overpriced home warranty, or you may want to watch my video on how I manage my real estate reserves. While I'm on overpriced insurance, I have to touch on whole life insurance. I've heard a lot of people try to convince other real estate investors that you can use a whole life insurance policy as your own bank so you can save on interest. I will admit that you can use a whole life policy as your own bank, and it sounds like a great idea on the surface, but clearly there's a catch. These policies have huge initial fees, and if you took the same money you would pay into a whole life policy and put it in a standard index fund while buying an equivalent term life insurance policy, your returns would dwarf those in the whole life policy very quickly. But what about the ability to borrow against it? First, it will take you a very long time to build up a significant balance in the policy to allow you to borrow against it and save any significant amount in interest, while at the same time you would have amassed a sizable investment account if you had just invested it instead. Just look at the spreads and fees of both options, and you should be convinced fairly quickly yourself. Second, you are doing all of this to save a few percent in interest that is deductible anyway, which means the value of that saved interest is even less. Real estate debt is the lowest cost of money you can get, so go get more of it. The bank isn't gouging you. The debt market is hyper competitive, and this isn't the place to spend your time and tie up your money. Go buy and renovate your properties. Take advantage of the low cost of capital that mortgages offer. And if you really need or want life insurance, just buy a term policy and keep it separate from your real estate investing. Infinite banking does not make sense. Please run the numbers yourself. The only person winning in this scenario is the person and company selling you the whole life policy. If you like this video, please hit the like button and consider subscribing. If you know of any other annoying real estate related misinformation that I missed, please share them in the comments below, and maybe I'll do a part 2 with your suggestions. As always, I hope you enjoyed watching this video. Thank you for watching Kenton Knows, and I wish you the best of luck with all of your real estate investments.